in really volatile markets, it can seem like there's no real investing strategy that's going to carry you through and make you feel whole. And I think what is interesting to think about is a long time ago, even, as several decades ago, one strategy that people came up with is the idea of, rather than trying to beat the market per se, why not just actually try to earn the market return? And that's really with the origins of the idea that we're going to talk about today, which is the notion of an exchange traded fund, or an ETF. And certainly where it had its origins is this idea that maybe rather than trying to, pick a particular strategy that's going to win in very up markets, or pick another strategy that might do very well in kind of down markets, why not just rely on the idea that over the last 2 decades or so, the S&P 500 has returned well over 7%, and the idea is that over time, that compound interest you're going to earn from that kind of investment strategy is going to be one that's quite fruitful over a long enough time horizon. And so that's where we really wanted to get into kind of our discussion today. So again, I'm Erik Johnson. I'm a senior economist and vice president at BMO Capital Markets, and you're listening to a special edition of BMO Smarter Investing. And I'm very excited to have one of our foremost experts on exchange traded funds, Erin Allen, who's with BMO Global Asset Management, where she is a vice president of online distribution in the BMO ETFs team. So welcome to the podcast, Erin. So glad to have you here today and to help us learn a bit more about what exactly ETFs are and how younger investors might be able to take advantage of them.
Thanks for having me, Erik. I'm looking forward to our discussion today.
Yeah. So I guess, to kind of carry off where I started is this idea of, what are we talking about when we're mentioning this idea of an exchange traded fund or an ETF? And, is it the same thing as if I'm going to go out and buy, a share of NVIDIA, or if I'm going to go, try to find a similar mutual fund or something like that?
Sure. Yeah. Let's start with the basics here. So ETF stands for exchange traded fund. So just as it sounds, it's a type of investment fund that trades on the stock exchange. So it is similar to individual stocks in that sense. But what it does is it holds a collection of assets. So it could be stocks, could be bonds, commodities, or other asset classes, or a combination of these. And, traditionally speaking, as you mentioned, they were designed to track an index like the S&P 500, for example, but there's hundreds of indexes out there that it could track. However, as you mentioned, more and more recently, there's been a lot of innovation in the space, and we've actually seen a lot of active ETFs coming to market as well. But if I compare an ETF to a stock, they are similar, like I mentioned, in that they trade in real-time prices on a stock exchange. But they differ, of course, in that a stock represents share in ownership of one company, and an ETF invests in a diversified basket of securities. So what that really means is you're lowering your overall risk. You're not putting all your eggs in one basket, and that's a big benefit of ETFs. They create that instant diversification. If we look relative to a mutual fund, again, an ETF differs in that it trades in real-time prices on a stock exchange, whereas a mutual fund, you can only trade it once a day at the net asset value of that day. So that's a big difference. And then, of course, the big factor that ETFs are really known for is the cost. ETFs are traditionally a lower cost investment than a mutual fund. Not always the case, but, more often than not, they are a lower cost alternative to a mutual fund as well.
Yeah, and I think what you kind of brought out there is something I was thinking a lot about, is this idea that, I think certainly as a young investor, it might be, feel attractive to, I want to go out and buy an individual company stock. And I think in particular in volatile markets, as much as say, the S&P 500, correcting over 3% in a day is something that's very hard to sort of see as a younger investor, any investor really. If you just owned an individual stock in that same episode, you might see, the volatility on that stock be at least in the double digits. And so this idea that you brought up of that when I'm buying an exchange traded fund, I'm not just necessarily buying one thing, but I'm buying a basket of assets that potentially is going to have slightly lower volatility relative to owning any one individual thing. It's the idea I'm getting instant diversification as opposed to having to go out and do it all that myself. So I thought that was, a really important kind of point, certainly given the past, big kind of episode we saw after kind of the U.S. labor report came out for July there.
For sure. And if you think about the cost to go out and buy, let's say 500 of the largest cap US stocks, the cost to buy and sell those, to rebalance those on a regular basis is huge. So yeah, ETFs really shine in that perspective.
Yeah. And so you kind of were teasing at this a little bit when you were talking about just, some of the new strategies and also just the growth in the ETF sector we've seen. But one thing I was wondering, if we think back to the early days when it was just basically Vanguard and SPY, kind of thing, where have you seen kind of this industry go over the last, 5 to 10 years in terms of, how much bigger it is, and also just, how many different market participants are in the ETF space than, it was back in, those early days?
Yeah, I actually joined BMO Global Asset Management 15 years ago, and we launched ETFs. I believe it was that year. It was that year, the year before. And it was, everybody's kind of looking at us like, oh my gosh, what are you doing? Like, you have this whole active management side of your business. But, we've seen huge growth since then. So 15 years, BMO ETFs just hit our 15 years mark. And we were one of the first entrants in Canada. There are, more than 40 ETF issuers in Canada, more than 1,300 products, new products being launched every single month. So this is a very growing part of the market, and for really good reason. But if we look at the overall cumulative growth rate over the last 10 years, it's been 20% on an annual basis. So huge growth. And I think we're on track to seeing another record-breaking year this year. And what I will also say is that it's been interesting in that it's not just all equity ETFs, as some might, think. Fixed income, balanced ETFs, we've seen growth across the asset classes, which is interesting as well.
Yeah, and I think maybe it speaks to this idea that there's, a lot more people interested, say, where we are today than maybe 20 years ago in, investing in stock markets, investing in kind of fixed income assets where, yeah, it used to be a little bit slimmer of a majority or slimmer of a group of people who were, actively kind of investing in the market today. But I think having some of these options available is really changing, the landscape of what an investor looks like, what, kind of assets investors are choosing to buy, and just the available stock out there. So I don't know, I think that's very exciting. If you're like a young investor today, you're just in a very different landscape of opportunities and options out there, as opposed to, as you mentioned, the idea of having to try to do this yourself to own kind of a diversified basket of stocks would have been prohibitively expensive and just would take tons of time because you'd be, constantly rebalancing your own portfolio, most of the quarter and most of the year, certainly. And you were kind of getting at this as well. And I guess, we've talked about this idea of where ETFs got their start a little bit, is the idea that, maybe traditionally some other kind of funds were a little bit more expensive from, kind of what you were paying in fees relative to the potential returns. So I guess other than, just the cost side, and, certainly speak to that as well, but what are some of the other benefits that maybe as a younger investor, if I wanted to, go out and buy an ETF as opposed to another kind of asset, what are some of the things that stand out to you in that regard?
Yeah, lots of benefits. So do you have an hour? No, I'm kidding. I think
maybe.
First and foremost, I talked about diversification. It is the only free lunch in investing, so many benefits to it. So the lower volatility that can bring to your portfolio is a huge benefit. Cost effective, you mentioned. Another benefit is that they're transparent. So you can know exactly what you're holding every single day. You go to the ETF issuer's website, you can download the complete list. That's really helpful when building a portfolio, and you can see how it overlaps with other holdings in your portfolio. And that was sort of groundbreaking 15 years ago when these came to market too. Is like, wow, this ETF issuer is actually sharing what I own. That's great. Mm-hmm. Flexibility is another benefit with the increase in ETFs available to us. There's a lot more options. So we have hedged ETFs, we have unhedged ETFs, we have US dollar ETFs. So that flexibility to really get the strategy that you want has been huge.
And I guess if you wouldn't mind, when you're referring to kind of the idea of a hedged ETF out there, what for an investor, what would that typically mean? Like, would they be insulating themselves from a particular kind of risk or a particular kind of currency? Like, maybe just give a little bit of an explanation for the audience there.
Yeah, you got it. So you can either invest in an unhedged ETF, and then you have full exposure to whatever currency that ETF is investing in. So if it's an emerging markets ETF, you can imagine all the different currencies that you might be gaining exposure to in an unhedged version there. Hedging basically takes the currency out of the picture. So you're just getting that increase or decrease in the value of the underlying shares, and you're not being exposed to the underlying currency, whatever that may be. And a lot of investors like that because they probably don't know much about what's going on in the Japanese yen or whatever.
Yep.
And taking that out of the picture can really just make it a little bit more clear and reduce that currency risk. Over time, however, there have been a lot of studies that show that, currency volatility will just even out, and that, potentially an unhedged version, you'd be in the same position at the end of the day anyway. So there's some considerations there. There's a cost to hedging as well, which should be considered if you're an investor looking at a hedged ETF. So just some things to think about there.
Yeah. And I guess maybe if we could dive a little bit into the idea. So, if I think back to, mutual funds, generally why, this particular product of ETF really sort of had its origins is the idea of trying to deliver something that was, giving investors access to equity markets or access to fixed income markets at a lower cost. But I guess why are ETFs able to deliver lower costs in a way that, other kind of financial assets, might be also investing in similar underlying assets, but are doing that at a higher kind of cost to a potential investor?
Yeah, I think, again, a lot of people think of ETFs as low cost because the majority of them track an index or they're passively managed. And that just means a whole lot less resources for the portfolio manager on the other end. They're just responsible for replicating that index and rebalancing to that index over time. Whereas an active manager, you can imagine there's a lot more going into those decisions. They're looking at the valuations of the company. They're researching the risks associated with them. They're making tactical shifts in the portfolio to get out of the way of particular risks. So that costs more. And I think that's something that investors can understand. I think that ETFs coming to the market in general has really increased competition, not just among other ETF issuers to drive the cost down, which has been great, but it's also put some pressure on those active managers to bring the cost down too. So overall, they've really helped from a cost perspective.
Yeah. And I guess...
one other thing, Erik, is that they also trade... I wanted to mention that ETFs trade for free on a lot of online discount brokers as well. BMO InvestorLine has, I think, close to 100, if not over 100 ETFs trading for free on their platform, but many brokers offering ETFs for free.
Yeah. And I think that always reminds me a little bit of when people, are similarly thinking about buying and selling, say, a real estate asset. I think it's very often that people don't factor in this idea of the actual transaction cost and what that means for their return. And so the idea that, I can go out and buy a zero cost ETF, and certainly for smaller, investment moves, if I have to pay something like a, $10-ish fee to kind of trade that financial asset, that might actually represent a pretty, significant hit on the potential return if I don't have a really long holding period. But if I'm, instead buying an ETF, all of a sudden that transaction cost is kind of gone, at least from that asset. And so that can actually, make a bigger difference, I think, sometimes than people realize. In the same way that, I think if you're not factoring kind of all the real estate fees when you buy and sell a home, similarly, like it can really eat into the return.
For sure. For sure.
Yeah. So I think you were talking a little bit about some of the new movements in the ETF space in terms of what some of the trends in the marketplace you're seeing, and are those new trends the things that are driving a lot of the growth in the ETF space, as opposed to, just everything, all the growth being into more people pile into index fund like ETFs, in your view?
I think there's a lot of different driving factors that we're seeing at play here. So definitely just the fact that they've been around for some time now, right? Like mutual funds are almost 100 years old in Canada. People are familiar with those. ETFs, 15, 20 years old. So I think that has really helped. Investors have had access to more resources to become educated on them. You mentioned that shift towards passive investing as a trend. And I think that's grown by just the increase in available research around that as well. I can point to S&P's huge wealth of resource they've been doing for 20 years now, called their SPIVA research, which stands for S&P Index versus Active, where they look at indexes versus active managers. And what they've shown is that indexing outperforms active managers in a lot of a high percentage of the time. So that has been groundbreaking. I think technological advancements have helped. This move to the online discount broker world has spurred this trend of ETFs as well. This trend towards getting the costs as low as you possibly can on your investments. Demographic shifts. We saw a ton of younger investors getting into investing during the pandemic. I hate to bring that word back.
Yeah.
But that really spurred this interest in ETFs as well. And then I would say the last but not least, institutional adoption. So oftentimes as we see institutions increase their usage of different strategies, this validates the asset class and encourages those retail investors to follow suit. And we've definitely seen a lot of institutions using them as well.
Yeah, I guess. And one point you kind of brought up in line with the S&P research is I was certainly blown away. I mean, maybe not completely blown away, but certainly a little bit surprised when even the Canada Pension Plan came out in their most recent annual report and was comparing kind of since their shift to active management, they've slightly, again, they've outperformed an index by, a tenth or two. But again, a tenth over two over, 20 to 25 years of active versus passive management, makes a huge difference on a potential return. And so this idea that, yes, I think there are often many reasons why it can be very fruitful to take a, active management stance as opposed to a passive management stance. But again, it is very hard to beat the market over a long period of time. And, even as sophisticated as, a big pension plan like the Canada Pension Plan is, they've even admitted that they've struggled to beat kind of an index there. So I found that, very much in line with the S&P research as well.
For sure. And your average Joe out there doesn't have time to be researching all these stocks, right? So if you're trying to do it yourself and you're trying to keep your costs low, ETFs are a great option.
Yeah, absolutely. So I guess, we've been talking about exchange rated funds, and you've certainly been mentioning different kind of asset classes that might fit into, an ETF today. But in your view, what are the different kind of ETFs that are out there and available for investors?
For sure. Yeah. So we've talked a lot about sort of the broad-based, index-based ETFs like the S&P 500 ETFs, the TSX Composite ETFs. So broad-based equity or fixed income ETFs, I would look at as a bucket. Outside of that, you have different sector or industry-specific ETFs where you can target the technology sector as a whole, the healthcare sector as a whole, energy, infrastructure, those type of things. Within fixed income, I think what's important to note is that at BMO, we've actually segmented the market completely to give investors the ability to target specific segments of the market. So segmented fixed income has been a really important innovation in the ETF space. We've segmented it based off of the term to maturity, the different sectors. You can invest in just corporate bonds, you can invest in just government bonds, just high yield bonds. So segmenting that market has really helped investors be able to tactically shift their portfolios. Thematic ETFs is another big bucket, I think, that we've seen over, I want to say maybe the past 3 to 5 years really come to light. They focus on trends or themes. If I think of a few of those, it would be things like clean energy, artificial intelligence, blockchain technology. Another big bucket that's really interesting is smart beta or factor-based ETFs. And these are ETFs that target specific factors or characteristics of a stock.
So that would be like growth versus value kind of thing?
Yep, exactly. Our dividend approach or a low volatility investment approach where they look at stocks that have lower volatility relative to the overall market, quality. If you have a specific style that you like, you can find an ETF sort of to match that with those. And then last but not least, I mentioned these before, currency ETFs, currency hedged or .U ETFs, as we call them, for US dollars are another bucket.
Gotcha. And so maybe, obviously as, the available product space is changing, certainly, even targeting a sector is, moving a little bit more to active management in the sense that, I have to think a little bit more carefully of how I target the sector. Is it, just stocks in a certain index in that sector, a certain, kind of geographic area. But, in your view, is are more and more ETFs no longer just what we might think of as these passive, index type funds that are trying to own everything, say that's traded in S&P 500 or everything that's, traded in the TSX. Is that sort of some of the things you're seeing as well?
Yeah, I think at the end of the day, the do-it-yourself investor has become a lot more sophisticated than they were maybe 20 years ago. And that has led people to want to be more tactical with their portfolios. So, the market really demands what gets launched at the end of the day. And we have seen a lot of success in the sector-focused ETFs. There's a lot of different approaches you can take with those sector rotation strategies where you're rotating into or out of defensive sectors, depending on where the market is.
And defensive would be the idea that investing in companies that are maybe more likely to be kind of recession proof in maybe slower economic times. Is that the kind of idea there?
Yep, exactly. Like things like financials, for example, would be a defensive sector, whereas energy, is a bit more volatile. You can even think of like if you work in a specific industry, you might want to, diversify your portfolio away from that and heavy up on different sectors. Technology has been such a hot sector this year. A lot of investors investing in that earlier on this year and really seeing the benefits. But yeah, I think it's just allowed investors to be a little bit more hands-on with their portfolio. Not for everybody. There are still a lot of what we term couch potatoes out there who just want that passive investing style, and that's great, but depends on what you're looking for.
And so, certainly you've talked a little bit about just the idea that, do-it-yourself investors just, have a lot more coming to the plate when they're thinking about possible investment strategies today. But in some ways, have ETFs also, kind of democratized investing a little bit more? This idea that, there are a lot of strategies that say, only an institution like, say, the Canada Pension Plan or, teachers or OMERS or something were able to, kind of pursue, because in order to do that, you needed a really big asset pool. It was typically high cost. So even if you offered it to clients, the buy-in would be super high. And, if I only have $100 or $500 or $1,000 to invest, my hopes of being able to, make use of that kind of investment strategy was just kind of completely out of the window. So have ETFs, flipped the script a little bit there and, maybe offering some of those kind of strategies that previously were, maybe unaffordable and unavailable to your average kind of retail investor?
Absolutely. And great question. I think this is truly the greatest win to come out of the ETF innovation. They have opened up access and democratized access to different asset classes that the average do-it-yourself investor, it was very challenging for them to actually access. Fixed income is a really good example of that. If you tried to do that yourself on an online discount brokerage, you'd have to, manage the maturities of all the bonds in your portfolio. They trade over the counter. You'd be paying high fees on those. Fixed income ETFs have turned that upside down, giving investors access to institutional level pricing on fixed income, to a diversified portfolio of bonds, which we know is a huge benefit. And it's really simplified the fixed income world for everybody. Another example would be international markets. For the most part, you can't trade in international markets at most online discount brokers. So do-it-yourself investors would have to buy, typically ADRs, American Depository Receipts, trading on U.S. exchanges. Now with ETFs, you can trade international stocks and bonds whenever our market is open, right? That's another thing. You don't have to wait and set your alarm for the middle of the night when the Tokyo Stock Exchange is open. You can trade your ETF during regular Canadian market hours. And then I think the last example of this would be a lot of the option strategies that have been launched in ETF form. Each option strategies, you have to have a certain level of expertise. You have to have a certain level of time available to yourself to manage these. So the innovation of covered call ETFs, as an example, have been huge in saving time and money for investors. I guess just to if we have a new relatively new investor, when they see something like a covered call technology ETF or a covered call banking ETF, what does the covered call piece of it mean when they're thinking about buying that ETF? Yeah, you're writing a call option on the underlying stocks in the portfolio, and the benefit of that is that you earn a premium. So it's a strategy for investors who need that cash flow, that monthly cash flow. So with a covered call, you are capping some of the upside on that underlying stock, but you are receiving a premium. So it's sort of, earning the income today, giving up some of the capital appreciation from tomorrow. Is sort of how you look at that strategy. And it's very time consuming and it requires a lot of expertise and there's costs. And, BMO is the largest options writer in Canada. And there's a certain cost efficiency that comes with that and having us do that for investors in an ETF. But I think, more and more we'll see that innovation grow. You talked about, things like hedged funds or products that were only available to accredited investors. And I think that's where we're going to go. Asset managers think of ETFs as a vehicle now. It's no longer just a passive investment style. So anything can be launched in an ETF form, which is really exciting. We just launched buffer ETFs at BMO ETFs, which is like a structured outcome ETF that provides a little bit of downside protection. So I will say they will probably more than likely get a bit more complicated for the average do-it-yourself investor to understand. But the key here is that you will have access to it. And if you have that level of knowledge and expertise to understand what you're investing in, it can be a huge, huge benefit to them.
Absolutely. And I think what fascinates me a little bit about the ETF space is if you think of their origins, this idea of I basically don't want any exposure to individual, asset manager strategies. So this idea of, kind of capital asset pricing, like I don't want any alpha or any, individual strategy risk. Instead, what I want is just the market return. So I just want beta. It's interesting, certainly when you think of what's become very popular in the hedge fund space in the last few years, this idea of, kind of pod investing and multi-strategy investing, where instead they're going the opposite direction, where, they want basically no market return and all, idiosyncratic return. And I guess the one thing that, I was thinking about in the ETF space is that we're going to see kind of that, the space go full circle a little bit, where all of a sudden you're going to have ETFs that are essentially trying to do a little bit of what, a multi-strategy kind of fund is trying to do, where they're just trying to earn kind of that idiosyncratic return. And maybe the easiest way to think about that for, the audience out there is the initial way that this was often done was, say, what I'm really interested in is the beverage market. And so what I just want to think about in the beverage market is maybe I'm really, big on Pepsi, and I think Pepsi is going to be a really great company, but I don't really want to just earn the, kind of exposure to the overall beverage industry. So at the same time, I'm going to short Coca-Cola. And so really what I'm just, trying to trade there is the, idiosyncratic difference in underlying brand strategies between those two companies while, neutralizing anything that's common between them. And so I know, to me, the ETF space maybe going in that direction seems kind of compelling.
Sky is the limit. Yeah, I don't think we're going to lose that, index passive investor and the popularity there, but certainly there are more advanced strategies coming out, and that's a huge benefit. Even if we look at the markets and how correlated they've become over the past few years, the most recent downturn was a good example of that. Having some more of these alternative strategies, alternative asset classes in your portfolio are huge. We just launched a physical gold ETF at BMO ETFs as well, so that is an example of how that innovation can happen.
And I guess to your point too, like, as opposed to an individual investor, even just buy an ounce of gold, that like entry price into that is going to be relatively high. And then when you're also thinking about, okay, where am I going to store this gold? All these other kind of facets that go along with that. I think it's
you can buy it at Costco, but you're going to have to store it under your mattress. Exactly.
Yeah. So it's just adding all these opportunities to investors that are making it a lot easier to kind of pursue strategies that otherwise were basically, not unavailable, but prohibitively hard and expensive to kind of do on your own.
For sure. And
so I guess, we sort of talked a lot about, the available product space, how it's evolved, where it's kind of grown and where it's going. One thing I thought that'd be useful for, kind of potential listeners here thinking about the ETF space is when you're kind of looking at, this particular asset class, what kind of metrics do you think about when you're evaluating, the different ETF options out there?
Yeah. So once you've already defined sort of your investment objective or your goals, and you have this, set of products that you're looking at, you definitely want to look at fees. And what I'll stress there is the importance of looking at the management expense ratio, the MER, and not just the management fee. There is some interesting marketing going on in the ETF world right now, where a lot of ETF issuers might even show a 0% management fee on their ETF. And that is just marketing. You have to look under the hood. You have to go to that ETF issuer's website. And the best place to go is the ETF facts document, where you will find that overall fee. That is a legal and regulatory document. And as I mentioned, you might be surprised by what you find there after you thought the ETF was costing 0%. So make sure you're doing your due diligence around the fee. A lot of ETFs offering leverage nowadays. There's a fee to that. So fee is important. The next thing would be the index methodology, or, really just get under the hood and look at the underlying assets. Are you comfortable owning those sectors, those geographies? Understanding different caps on the index. Could technology go to 50% of my portfolio, or is there something in place that can stop that from happening? That's important for you. Make sure you're understanding how the index is constructed, what currency exposure you're getting, as we talked about. I'd say also look at the ETF provider. Are they a large, stable company that's been around, that's going to be around for years to come? I mentioned we have 40 ETF issuers in Canada. So there's, in recent years, we've started to see some consolidation, some shops closing up their doors. So I think making sure that you're partnering with an ETF company that's been around, that's going to be around, is important. And then, of course, performance. You can look at the performance. If the ETF's rather new, you can actually go to the index provider's website and look at that index performance to get a gauge, although you have to consider fees on top of that. But that's going to be important as well. A great place to start, BMO ETFs on BMOETFs.com. We just launched 8 new tools to help you sort of screen the Canadian listed ETF universe or compare. And
I guess one thing when you're thinking about, different ETFs out there is the trading volume, or, I guess how big the asset pool of that individual ETF. Is that something that an investor will want to consider as well?
It is important to a certain extent, but really an ETF is as liquid as its underlying holdings. So ETFs have a unique structure where they're actually supported by a market maker. So not only do you have the liquidity of buying and selling to other investors on the stock exchange, you also have a market maker there supporting the creation of new units, the redemption of units, and really making a market for that ETF to ensure that bid-ask spread is nice and tight for investors. A lot of investors do look at volume, but that market maker function at the end of the day is going to support the liquidity. So it's a factor, but it's not the only factor, if that makes sense.
No, I think that's very helpful. I mean, I think, that's a really tidy way of explaining it, I think, rather than just thinking about, I'm really nervous about owning something that's not traded very frequently. But I think to exactly to your point, if the underlying assets are, certainly highly liquid, then, obviously whatever fund is holding those things is also going to be fairly highly liquid as well. So you did kind of get at a few of those things. So maybe if you could expand a little bit. So if I'm, this kind of potential new investor who's thinking about getting started in ETF. So, one option is they could go explore, some of the new ETF tools that BMO has to offer. So one, what kind of tools are in that kind of suite of things, and what kind of information are they giving investors? And are there any other tips you might have for someone who's looking to get into this space as well?
Yeah, so the tools themselves are basically going to give you any factor about the ETF that you would be interested in looking at. You can look at their yield, how often they distribute, their dividends, what those dividends have looked like historically, the sector exposure, the geographic exposure. You will get everything there. Outside of the tools, and once you've found some ETFs that you like, if you just want to become educated around your options out there, around how people are using them, there's a lot of resources. I host a weekly podcast, ETF Market Insights, on YouTube, that I think is a great place to start, selfishly. But I think just continuing to educate through those online digital resources is great. There's tons of great blogs out there that you can check out. But the tools are going to get you sort of to that, those few tickers that you can actually make a decision based on, because 1,300 products is a lot out there, and you want to be able to screen that down.
Yep.
Yeah, you can also screen by things like, does the ETF use leverage? You could screen by dividend-focused ETFs. So really, it's a good way to start to find what you're looking for. And
I guess if there's, a handful of ETFs or a handful of types of ETFs out there for, an upstart investor here, what kind of things are like good intro ETFs for them to kind of explore if they're thinking about starting a portfolio in this space?
Asset allocation ETFs or all-in-one ETFs are really a great tool for newer investors. A lot of ETF issuers have them. BMO has a full suite from all equity, growth, conservative, balanced portfolios. So depending on your level of risk, you can pick that asset allocation that is best suited to you. Mm-hmm. And asset allocation is just that mix of stocks and bonds and other asset classes in your portfolio. And what these do is they're a one-ticket solution. So instead of going out and thinking, I need to buy the S&P 500 index and the TSX composite, I need some emerging markets, I have to have some fixed income too, which fixed income, I don't know. This is going to make it a lot easier for you to buy a professionally managed, low cost. So 18 basis points is the management fee on our asset allocation ETFs. One ticket solution. And then the other benefit of these is that they rebalance for you. So if you want that sort of set it and forget it type portfolio where as markets move, you're always going to be on track to that, let's say 60-40 asset mix that you've chosen, this will do it for you over time. So these can be used in a lot of ways too. So I think, for an investor getting started, because there's no minimum to buy these things like there are for mutual funds, you can get started with one of these. And then as you become more sophisticated, you could even adopt what we like to term a core and explore approach, where you would hold this as a core of your portfolio. And then you can, add a specific sector if you want to overweight a sector, or even individual stocks that you like on the side. And that can be a nice portfolio construction tool as well.
No, I think that's very helpful for, a young investor thinking about the available options out there, and certainly a little bit, easier on them than having to, sort through all the noise of, do I own NVIDIA? Do I own, all these other kind of stocks that trade today? So I think that's, something that I think anyone out there who's thinking about getting involved in investing for the first time, I think this is a space that, one, is just going to be very helpful for them. And again, is going to provide them just with so many more options than I think they would have been available to them, 10, 15 years ago. And even, some 5 years ago, as you mentioned as well. So.
Yeah, young, old, everybody can use these, right? I often look at them even as like a good, nice, clean nest egg to pass along. I think about my parents' portfolios and the 70 different stocks that if I were to inherit, I would have no clue what's going on. And having an asset allocation ETF transfer to you as a transfer of wealth is a nice nest egg as well. So I think they can be used, anybody can use these really.
Awesome. Well, thank you so much for spending time with us today, Erin, and for helping, the BMO Smarter Investing audience kind of learn a little bit more about the nuts and bolts in ETFs. And we look forward to maybe having you on in the future when there's kind of new innovations in this space as well. So thanks so much.
Thanks, Erik. Thanks for having me.
Awesome. Well, that's it for us today, and hope you enjoyed the episode. And we look forward to you tuning into some of our special edition episodes in the future. Thanks so much.